Welcome to Radical Personal Finance, a show dedicated to providing you with the knowledge, skills, insight, and encouragement you need to live a rich and meaningful life now while building a plan for financial freedom in 10 years or less. My name is Joshua Sheets. I am your host. Let's do a little bit of financial planning discussion. As you may have heard, the One Big Beautiful Bill Act has been passed by Congress, signed by the president, and is now the law of the land in the United States. And in the One Big Beautiful Bill Act, we have a number of changes to financial law. A set of new regulations, some new adjustments to numbers, and some new tax deductions, a couple new things, and we have a new set of accounts. A new set of tax-advantaged accounts that are commonly being referred to right now as Trump accounts. I'm going to share with you the details on those accounts in this show. Now, as with most things, of course, there's 870 pages in this bill, and just like most of the legislators who signed it, I, of course, wouldn't bother to read it. Neither would the president bother to read it. So what I am going to do is to do what all politicians do, which is just assume that somebody else smart has read it and then go off of what that person has read, because I'm not going to take my time to go and read the law. And so my smart man of choice, who I always follow for things like this, is Jeff Levine, who is a CPA, a CFP. He is the chief planning officer for Focus Partners. He's a professor of practice and tax at the American College, and he's the lead financial planning nerd at Kitces.com. If you are interested in finding him, you can find him on X at CPA Planner for all of his details. And so I'm going to use his thread whenever there's new legislation. Jeff is a nerd, a smart nerd who sits down and actually reads this stuff and then tells me about it. And then I believe what Jeff says and I pass that along to you. So in case you can't tell, I hope this is enjoyable for you because this is how our world works. Why would we ever read anything? But I want to read you Jeff's tweet thread. I'm going to make some commentary, but he is about 10 times as knowledgeable and expert as I will ever be. So I am indebted to him for his service to us, and I want you to be exposed to him. So let's begin with Jeff's commentary. This is from a tweet thread from July 3. So everything is passed according as expected, but this is July 3. Breaking news, the One Big Beautiful Bill Act, OBBB, One Big Beautiful Bill Act, has just been passed by the House and is now on its way to the president's desk, where it will be signed into law. With that in mind, it's time to break it down. While the One Big Beautiful Bill will have an enormous impact on many aspects of planning by recent standards, it's actually not as big. For as many areas as it covers, it comes in at a tidy-ish 870 pages. All right, let's dive in, beginning with taxes and a quick list of what's staying almost the same. 1. Today's 7 tax ordinary income brackets, 10%, 12%, 22%, 24%, 33%, 35%, and 37%, are now permanent. There is, however, a weird little inflation bump for the lower brackets, and this is what the text of the bill says. Inflation adjustment. Section 1J3BI is amended by inserting solely for purposes of determining the dollar amounts at which any rate bracket higher than 12% ends and at which any rate bracket higher than 22% begins before subsection F3. So there may be a little inflation bump here. I want to comment on these kind of income tax brackets with just my own observation. I have observed for many years that there is very little that changes with regard to American income tax rates at the moment. And I think that is because we have the IRS and the government has pretty well dialed into perfection the Laffer curve. And the Laffer curve is the basic idea. It's a theoretical model that illustrates the relationship between tax rates and total government revenue. And the idea is that somewhere between 0% and 100%, there is a perfect number that optimizes the total tax collected by the government. So if the government charged 0% tax rates, of course, government wouldn't collect anything. If the government charged 100% tax rates, it would collect basically nothing, because people would not be incentivized to actually do anything that would create tax revenue for the government. And so somewhere in the middle, there is a number that allows the government to collect the maximum amount of tax revenue without excessively changing people's decisions, meaning that people don't spend a whole lot of time thinking about taxes. That's the idea and the concept behind the Laffer curve. And I think that the US government has found those numbers and pretty well kind of figured it out. And I say that based upon observation and my own experience. The observation is this. In the United States, we have two political parties, and in theory, those political parties have differing views on taxation. In theory, at least traditionally, we have the party of low taxes, which has tended to be the Republican Party that says we want low taxes in order to stimulate the economy and to stimulate business. And then in theory, we have the Democrat Party, which says we want to tax the rich so we can tax the rich and take from the rich and give to the poor. Or at least that's what these parties are associated with. But interestingly, when the parties get into power, nothing actually changes all that much. Right now, President Trump, who is a Republican, has a Republican House and a Republican Congress. And what we see with his one big beautiful bill is that the tax rates range from 10% to 37%, which is not all that different than it was under President Biden, which is not all that different than what they were under President Trump, which is not all that different from what they were under President Obama and President Bush, etc. Basically, we are stuck in these numbers with these tax rates, and they don't change much. And I'm not sure that they should change much, because the reality is that these tax rates are not particularly low, nor are they particularly high. I would say they're quite low, all things considered, compared to many nations when you are at a low income rate. A 0%, 10%, 12%, these brackets are really low. If you were to compare the average taxes paid by an average, person who earns, 70 grand in the United States versus somebody who earns 70 grand in France, the US earner is much, much lower as far as the tax rates are much, much lower than the person in France. Now, obviously, there's a difference in government benefits received, but the point remains that they're pretty low. And then at the top end, the U.S. government has basically decided, well, we're not going to go out and try to be a tax haven. We're not Bahamas and Bermuda. We're not Cayman Islands. We're not Dubai. We're not one of these places that's trying to position itself as a tax haven. We're going to have a relatively high tax rate, but it's not so high that it's that off-putting. Many, many people who earn tiny fractions of what you would need to earn to be in a 37% tax bracket around the world pay much, much higher all around the world, and they sit tight. So even in my work in internationalization and international consulting, it's very hard to ever recommend to somebody that, your best solution to all of your tax problems in the United States is to offshore and to go offshore, because in reality, they're not that high. They're not that high. And even when they are high, there are a good number of workarounds available that solve the problem for most ordinary people. Now you say, Joshua, what do you mean? 37% is a lot. Yeah, but not that many people pay 37%, and those who do usually don't pay it for very long. Let me explain. There's a long-running debate in U.S. tax policy about what should the rate be. And if you go back to the 1950s, you find in the mid-20th century, you find that the top marginal bracket, was it 90%, something like that? It was 90% or close to it was the top marginal bracket. And first of all, I think that did disincentivize many people from working and earning more money because the rates were so high and you're going to lose too much. And then the counter argument is that there were quite a lot of tax loopholes available back then. So very few people ever paid 90% on their income. Well, what's happened over the last 75 years is that many, if not I have to say most, if not all, of those tax loopholes have been closed and eliminated, and the rates have come down. And so the 37% top marginal income tax bracket rate is a pretty consistent number, and there aren't a lot of ways around it, except for when there are. So in tax planning, generally speaking, you find that low-income earners don't pay much tax. High-income earners pay a pretty decent amount of tax here. I'm saying, okay, 30% is decent, until they become wealthy, in which case, because of the preferential capital gains tax rates and the ability to defer gains to the future, then many wealthy people wind up not actually paying so much money in taxes. So it all works out in the long run. And so this is kind of the annoying nature of the U.S. tax code, is that it's high enough that the U.S. government collects quite a lot of revenue. It's high enough that people grumble about it, but it's not so high that people actually make that many changes. The number of people moving from Florida to the Bahamas to save taxes is fairly low. And this also it's there as a backdrop. And of course, there are people who are living in high income tax states who make different arrangements among those states. But generally, it's too bothersome to try to leave the United States to go elsewhere. And all things considered, people tend to be fairly happy. And just they're high enough that people are grumbling, but they're not so high that people are changing. And I think that is different than some other places. I haven't looked at data to see what percentage of Canadians are leaving, but I see a lot of Canadians who are sharing videos online of here's why I left Canada. And it seems to me that Canada may have overplayed its hand a little bit. Some other nations may have overplayed their hand a little bit, and they have to figure out how to dial in their Laffer curve. But at any rate, we now know that today's 7 ordinary income tax brackets are permanent. And of course, when we use words like permanent, we use that in the tax planning context, which means that these aren't going to change unless a future Congress and president change them. So just keep that in mind, that does not mean that 20 years from now, these tax rates will be exactly the same. It just means that they're not scheduled to change automatically. They don't sunset. They don't disappear after 10 years or go up or down or anything like that. These are in the law now, and they are steady, which is a good thing. Predictability is a good thing so that people can make their plans. I also think that if I'm right in my assessment that we've dialed in on the Laffer curve, the practical implication for this is simply I don't think these tax rates are going to change much in the future. For a long time, my argument, which I hear repeat, with regard to IRAs, Roth IRAs, things like that, has been very simple. I have argued this. People say, well, what I should do is convert all my money to a Roth IRA now, or I should definitely put all my money in a Roth IRA instead of a traditional 401k, or a Roth 401k instead of a traditional 401k. I should do that now because tax rates are going to go up in the future. I say, how do you know the tax rates are going to go up in the future? People say, well, because the government is borrowing lots of money. Okay, I grant the government is borrowing lots of money. That is true. But here's what we know, that since the end of World War II, total taxes have never gone above 25% of GDP. And for decades now, we've kind of seen these numbers be fairly consistent. And I don't think the government thinks that it can push rates all that much higher. Even if Bernie Sanders came into office, I think that he would campaign on, we're going to push tax rates. We had at least half. And I think if they came in, he would raise them at 2 or 3 or 4%. So I myself don't plan for tax rates to change all that much. So I think you have to just plan around what tax bracket you're going to be in. Are you going to be in a lower tax bracket now while you are working, or in a lower tax bracket later when you're retired and not generating income? The answer to that seems obvious to me, which is why the significant majority of the time, I recommend to people prioritize a traditional 401k contribution over a Roth 401k contribution while you're working. And then if you're going to do a Roth conversion, just do the math. And of course, try to fill up your buckets of your conversion buckets when appropriate. But I don't think that excessive strategies make a lot of sense to me because I think tax rates are pretty well dialed in. So we'll see. Back to Jeff's tweet thread here. Number 2, itemized deduction rules staying the same. The PEAS limit, which is a 3% reduction in itemized deductions, permanently repealed. Miscellaneous itemized deductions are permanently repealed. And deduction for interest on mortgages, which is currently capped at $750,000 of principal, but allows some MIP to count. Now, the PEAS limit being repealed is a good thing for high-income taxpayers. This was a limit which previously reduced itemized deductions by 3% for taxpayers who had an adjusted gross income above a certain amount. So now it may be possible for high-income taxpayers to possibly pay less because now they can have more itemized deductions. I think the more interesting one is just that mortgage insurance is now mortgage insurance premiums, that's MIP, may count as part of the deductible mortgage interest. That's useful to know. So it's nice to know that you can deduct possibly up to $750,000 of more on a mortgage of mortgage interest. Let's move on. Next, personal exemption deductions are permanently eliminated. ABLE-related rules stay the same, so contributions are eligible for the Savers Credit. 5 to 9 to ABLE rollovers allowed. ABLE beneficiaries are allowed to contribute up to the federal poverty limit. Number 5, employers permanently able to pay up to $5,250 indexed towards employee student loans and exclude from income. So this one is one that I think is interesting to me. So this will open up new potential avenues of payment that an employer can pay up to $5,250, and that number will increase in the future, towards employee student loans, and those payments can be excluded from income. So if you are an employer who wants to have an educated workforce and wants to offer this, this can be a way of offering a tax-free benefit towards your children, towards your employees. maybe a little Freudian slip was true there. Towards your employees to help pay down their student loans. And I think that's a nice benefit to offer. So that should be deductible for the employer, and it's non-taxable income for the employee. So that may be a bonus that we look for. I'll be interested in years to come. The children thing was, I'll be interested to see if there are any rules related to that with regard to employing your children, and if that could be part of the benefits of a family-based business as a nice little extra perk. I don't know. I'm not sure. That'll be interesting to see what those rules are. For now, I haven't dug into the rules. Number 6, limitation on excess business losses made permanent. I don't know what that means, so let's go forward. All right, I had to look up the numbers here. So the limitation on excess business losses being made permanent means that non-corporate taxpayers are subject to a cap on the amount of business deductions they can claim, which is set at the sum of their aggregate gross income or gain from trades or businesses plus a threshold amount. For taxable years beginning in 2021, the threshold amounts were $262,000 for single filers and $524,000 for joint filers adjusted for cost of living. This limitation ensures that business losses cannot exceed these thresholds, treating any disallowed excess as a net operating loss carryover to the following taxable year. This provision aims to prevent taxpayers from using business losses to offset other types of income excessively, thereby maintaining a balance in tax revenue collection. So the idea here is if you kind of go and set up a business that in reality you're just trying to lose money in, but you can somehow magically check all the dots so that it is a genuine business and not subject to hobby loss rules, well, guess what? You can only deduct the amount of money either that you earned up to your revenue or up to $262,000 more for single filers or $524,000 for joint filers. And so that has been in place for a number of years now and is now made permanent. So that I'm happy with that. That is fine with me. Now, let's drop down a little bit. And Jeff says, okay, now on to the actual interesting stuff. Let's start with SALT. The Senate ended up changing its initial draft to more closely mirror the House's language. Here are the specifics. The maximum potential SALT deduction is increased to $40,000. The $40,000 amount is reduced to as low as today's $10,000 max as AGI exceeds $500,000. The actual phase out is a reduction of 30% of income over $500,000. So the extra SALT deduction is fully phased out at $600,000 of AGI. SALT, by the way, is state and local tax deduction. That makes the $500,000 to $600,000 income range extremely important from a planning perspective for those with high SALT. Because, absent any other factors, increasing AGI from $500,000 to $600,000 means taxable income could rise by $130,000. So, continuing on, other important notes on SALT, state and local tax. The $40,000 maximum deductible amount applies to everyone, but married filing single taxpayers, $20,000. So the marriage penalty remains. Speaking of the marriage penalty, in some ways it's worse because the $500,000 threshold amount also applies to everyone, but married filing separately. Good news and bad news. The increased SALT deduction cap is effective for this year. So that's the good news. Bad news. While most provisions are permanent, raising the SALT deduction cap like this is expensive. So to limit costs, it's only effective through 2028. Then back to the TCJA, the Tax Cut and Jobs Act, $10,000 and $5,000 limit. And the last good news, bad news, SALT tidbit. Good news, both the $40,000 cap and the $500,000 income threshold are indexed. Bad news, at a statutory rate of 1% per year. I like it. It's funny. 1%. Let's index this at 1%. So the practical application of this, I would just say, first of all, if you are an income earner that's right around that $500,000 a year number, then you should pay attention to this. And if you have a lot of state and local taxes to deduct, then pay careful attention to this. And so, check this out and think about that with regard to your adjusted gross income with, just pay attention to that because that may penalize you by not being able to deduct your state and local taxes. All right, continuing on. Number 15. On a related note, let's talk about pass-through entity taxes, or PTETs. Pass-through entity taxes are where business owners effectively pay their SALT taxes through their business instead of personally as a way to get around the SALT deduction cap. The final OBBB does not affect PTETs. I don't know why we do this in American English. Note that this is a departure from both the original House and Senate versions of the bill. Each had sought to limit PTETs through via different methods. So, to understand this PTET structure, let me read you a bit of an article from a month ago from the Tax Foundation. Now, this is out of date here because we know that PTETs were not limited in the final version, but this explains it. So this is an article from the Tax Foundation. Senate softens blow for pass-throughs using current SALT workarounds from June 18, 2025. 36 states use pass-through entity taxes, PTETs, to allow pass-through businesses to avoid the state and local tax, SALT, deduction cap. But the House's version of the One Big Beautiful Bill would have stripped this benefit from legal, accounting, medical consulting, financial, and other businesses classified as specified service trades or businesses, SSTBs. The Senate, in its language, restores the benefit of these workarounds to all pass-through businesses while placing new limits on the extent of the workarounds. Under current policy, pass-through businesses can elect to remit entity-level taxes, which provide a credit against the owner's individual income tax liability, essentially avoiding the effect of the $10,000 SALT deduction cap on that income. The House raised the cap to $40,000, though phasing it back to $10,000 for high earners, with the phase down complete at $600,000 in AGI. Pass-throughs other than SSTBs could continue to use PTETs to avoid the cap, while SSTBs were denied their use and are fully subject to the cap. The Senate retains the existing $10,000 cap, but strikes a new balance on the use of PTET workarounds. Under the Senate plan, income that states tax at the entity level is, for each owner, deductible as follows. 1. Any portion of the $10,000 SALT cap left over for the owner after their personal deductions for other income and property taxes may be deducted for PTE taxes. 2. Above that, the greater of $40,000 or 50% of the PTE taxes are deductible. The Senate cracks down on some states' practices of using PTETs as a revenue generator. Some states impose higher rates for entity-level taxes, either by taxing all income at a flat rate equal to the top rate of the graduated rate income tax, or by imposing a separate higher rate. Businesses sometimes elect to pay this higher rate because it yields federal tax savings that exceed the additional state burden. But the Senate does not want the deduction to subsidize higher than usual state rates on business. So, there's been much debate in recent months about the propriety of business SALT deductions. We've noted in the past the case for corporate SALT deductions is strongest. These taxes are imposed on the corporation itself. Formulary apportionment means that a corporation's choice of location does not affect its state corporate income tax liability. States separately tax the income distributed from the business, and the deductions do not offset any taxes on the personal income of business investors or employees. So I don't have any insightful commentary to add to this. You know what you need to know, I guess, if this is appropriate for you. Now, number 17, moving on to the QBI deduction. House bill would really have changed QBI planning by changing the phase-out formula, qualified business income planning, by changing the phase-out formula in a way that would have allowed a lot of high-dollar, white-collar professionals, for example, doctors, lawyers, CPAs, advisors, to claim the benefit. But alas, it wasn't meant to be. The final OBBB permanently extends the QBI deduction, but makes only minor enhancements to the rules. The enhancements. Phase-out range now covers $150,000 of income for joint filers and $75,000 for all others, up from $100,000 and $50,000, and a $400 minimum QBI deduction of at least $1,000 of business income. So anyway, sorry to all my CPA, financial advisor, attorney, and other high-income white-collar professional friends. On the bright side, your QBI deduction will continue to be very easy to calculate. Unfortunately, that's because it's always going to be $0. And by the way, dividends from business development companies, BDCs, income didn't make it into the final bill either. Okay, now that we've covered the changes to the QBI deduction, let's get nerdy for a moment, as if that's not what we've already been doing. As we sit here today, the QBI deduction is a one-of-one deduction. There are no other deductions like it. Here's what I mean by that. In general, deductions are either above the line, ATL, or below the line, BTL. Above the line deductions lower adjusted gross income and taxable income, and you don't have to itemize to take them. Below the line deductions don't lower adjusted gross income, and you can only claim itemized deductions if you itemize. Duh. The QBI deduction does not fit into either of those groups. Why? Because you don't have to itemize to claim it. You can take the standard deduction and the QBI deduction, but it does not lower AGI. It's a deduction unicorn, which is why it gets its own line on the Form 1040. So at this point, you might be wondering, hey, Jeff, who cares? Why the grand lesson on deductions? Well, here's the answer. The QBI deduction is about to get some friends. It will no longer be in a category by itself. In fact, the QBI deduction will now be one of four. Let's talk about the three others. 1, starting with no tax on tips. Objectively, no tax on tips is a bit generous. It's really no income tax on some tips to be accomplished via a deduction. Here are the key details. The maximum deduction for tips is $25,000 and applies to all taxpayers except married filing separately, MFS, who get nothing. You lose. Good day, sir. Deduction is phased out as income is greater than $300,000 for married filing jointly, $150,000 for others. phase out as 10% of income over threshold, so a $0 deduction for married filing jointly at $550,000 and at $400,000 for others. There's a whole lot about what constitutes a qualified tip that's eligible for the deduction. We're going to skip that here. I'll just say tips have to be a normal part of the business, and that the IRS will publish a list of occupations where that's true within 90 days. Remember, no tax on tips is just no income tax on tips. Tips should still be reported and are subject to employment taxes. The deduction for tips is effective for this year, 2025. Almost forgot, the deduction for tips ends in 2028. Now, let me just comment. I don't have much to say about this tax deduction. I think it's the kind of thing that demonstrates kind of good political posturing, good political thinking. I think that even though there's a whole bunch of rules around these ideas, I think this clearly demonstrates intelligent thinking, political thinking by President Trump and the Republicans to put this in, because President Trump will be the person who finally said, yeah, well, I don't have to pay tax on my tips anymore. The big change that seems obvious to me is that very rarely have tips, cash tips, ever been taxed, because the vast majority of people who receive cash tips do not report that income, even though the law indicates that they should report that income. But as we've gone away from cash and now everything happens with a card and you put your tip on with a credit card, and as the tipping culture has become more intense, where now 20% tips in the United States are expected, then that becomes an important part of it. And so now this deduction allows somebody who receives a tip allowance from the restaurant based upon the credit card processing to now use this deduction and eliminate income taxes on those tips. Probably a smart political move. I don't know that it matters all that much. I doubt that. I don't want to say something I don't know, so I'm sure it will matter to some people. The reason I'm hemming and hawing is just that what percentage of people who are working in tip-heavy industries are actually paying any kind of significant income tax? It's a modest percentage. It's not most, but hey, it's great. I don't mind it at all. Number two, no tax on overtime. Similar to earlier, this is more accurately described as no income tax on some overtime. Key rules. The maximum deduction for overtime is limited to $25,000 for married filing jointly, $0 for married filing separately, and $12,500 for all other filers. The deduction is phased out as income exceeds $300,000 for MFJ and $150,000 for others. Phase out is 10% of income over threshold, so a $0 deduction for MFJ at $550,000 and $275,000 for other. Only qualified overtime is eligible for the deduction, but as seen below, they're using a pretty straightforward definition here. The no tax on overtime deduction is applicable for this year, 2025, and the deduction is only applicable through 2028. So let's read from the law. Qualified overtime compensation. 1. In general, for purposes of this section, the term qualified overtime compensation means overtime compensation paid to an individual required under Section 7 of the Fair Labor Standards Act of 1938 that is in excess of the regular rate, as used in such section at which such individual is employed. Makes sense to me. So I think the key thing here is you'll want to maximize this. So if you have the opportunity for overtime pay, then now you are incentivized to get it, because not only can you receive a higher pay rate for the overtime that you work, but now in addition to that, you can potentially receive that higher income without income taxes due, which is really nice, because that can make all the difference. Let's say that you were making $100,000, but now before this tax deduction, if you worked an extra $25,000 of overtime, that would have led to you having that top $25,000 taxed at your highest marginal bracket, well, now you're going to work the $100,000 and you're going to have that $25,000 income tax free, which is, I think, great. And so this is a good opportunity for, I think, lots of ordinary people who are entitled to overtime pay to really put extra money in the bank. And I would challenge you, if you have the opportunity for overtime, try to use this as your wealth fund. Use it as a way to earn money at the highest possible rate and then set that aside tax-free and use it to really build your wealth. So if you've got opportunities for overtime, try to do it. You'll be glad that you did. That leaves us with one more deduction to add to the group I call below the line deductions. Number 3, charitable deduction for non-itemizers. This one is simple. In short, if you don't itemize, joint filers can still claim a $2,000 deduction, $1,000 for others. A few additional details. This provision is permanent and it's effective next year, 2026. If this provision sounds familiar, that's because we've seen it before. We temporarily had a provision like this for a more limited dollar amount back during the pandemic. So instead, if you just ordinarily take the standard deduction, the benefits of having charitable deductions are limited for you to the benefits of the charitable contributions, not a tax benefit. But this now allows you to deduct $2,000 or $1,000 for your charitable contributions, even if you don't itemize deductions. So I think that's great too. Okay, so there we have it. For 2025, the group of below the line deductions now totals 3. 1, QBI deduction. 2, tips deduction. 3, overtime deduction. And in 2026, a 4th deduction will be added to the mix. 4, charitable deduction for non-itemizers. Remember, the key planning point is simply that while you don't need to itemize your deductions in order to benefit from any of these tax breaks, they will not reduce your AGI. Now, while the OBBB giveth a nice charity-related tax break to non-itemizers, it taketh away some tax benefits for charitable contributions from those who do itemize. Specifically, there will be a 0.5% AGI floor charitable contributions must exceed to be deductible for those to be itemized. Think of this similar to the way that itemized deductions for medical expenses work. There, the hurdle rate is 7.5% of AGI. So if your AGI is $100,000 and you spend $12,000 on medical expenses, only $4,500 are deductible because the first $100,000 times 7.5% equals $7,500 are non-deductible. Similarly, beginning next year in 2026, if your AGI is $100,000, then your first $100,000 times 0.5%, which equals $500 of charitable contributions, will not be deductible. Okay, one more item on charitable deductions. The 60% AGI limit for cash contributions made to 50% organizations is made permanent. At this point in the thread, Jeff took a break, and then he comes back at it. He says, okay, back at it. Sorry for the delay, but I needed to reset and clear my head. I also ended up going down a rabbit hole of epic proportions that led to rereading several sections of the code and the Tax Cut and Jobs Act. Why? All to better understand the deduction for car loan interest. Guess what? Remember how I said that soon there were going to be 4 deductions in that below the line deduction group? I lied, because this car loan interest deduction is going to be the 5th. Here are the key rules to know about this one. The maximum annual deduction for this purpose will be $10,000. The deduction is phased out as modified adjusted gross income exceeds $200,000 for joint filers, $100,000 for all others. The phase out is 20% of income over threshold, so a $0 deduction for MFJ at $250 and others at $150. The deduction is applicable for qualifying loans incurred beginning this year, 2025, and through 2028. Lots of limitations here, but the big ones to me are lease financing does not count, new cars only, and final assembly must occur within the U.S. Let me read to you from the text of the bill. Exceptions. Such terms shall not include any amount paid or incurred on any of the following. 1. A loan to finance fleet sales. 2. A loan incurred for the purchase of a commercial vehicle that is not used for personal purposes. 3. Any lease financing. 4. A loan to finance the purchase of a vehicle with a salvage title. 5. A loan to finance the purchase of a vehicle intended to be used for scrap or parts. VIN requirement. Interest shall not be treated as qualified passenger vehicle loan interest under this paragraph unless the taxpayer includes the vehicle identification number of the applicable passenger vehicle described in Clause 1 on the return of tax for the taxable year. And then applicable passenger vehicle. The term applicable passenger vehicle means any vehicle that, 1, the original use of which commences with the taxpayer. So that means a new car. 2, which is manufactured primarily for use on public streets, roads, and highways, not including a vehicle operated exclusively on a rail or rails. 3, which has at least 2 wheels. 4, which is a car, minivan, van, sport utility vehicle, pickup truck, or motorcycle. 5, which is treated as a motor vehicle for purposes of Title II of the Clean Air Act, and 6, which has a gross vehicle weight rating of less than 14,000 pounds. Such term shall not include any vehicle the final assembly of which did not occur within the United States. So to revise, back to Jeff's notes, and then I'll comment. So to revise my earlier note, there will be 4 below-the-line deductions this year: QBI, auto loan interest, tips, and overtime, to be joined by charitable contributions next year. Tough to fit it all on a 1040, so I'm thinking another schedule may be created. Now, this is an interesting provision that we can deduct automobile interest on a tax return. Again, I don't have much to say about this. I think it's politically shrewd to seek to do that. I understand and appreciate them trying to encourage this for American assembled vehicles. That's probably a good move. The auto industry will be grateful for this, and lots of people will be grateful for it. So if you're going to buy a new car, this deduction for the interest cost on it may make it more accessible for you, and you'll want to consider the benefits of financing a loan. I think we're going to see people with this deduction. I think we're going to see more people being willing to finance the loan. Seems to me that a big change has happened in the new car market, where really, because the dealers are paid for the financing packages that they sell, you don't get any actual negotiating ability if you wander into the a new car dealership with a checkbook in hand saying, here, I'm going to write a check for a car, and what do you take for a check? The new car dealer would much rather you show up without any money and take out a maximum loan so that he can get his commission on the sale of the loan. I think that that's something that has impacted personal finance stuff quite a bit. So this will just continue that effect, that not only will you get more negotiating power if you're taking out a loan, but now the fact that you can deduct the interest expense separately is a useful thing. Now, the same logic from a personal finance perspective is going to apply. This relates to homeowners' mortgage interest deductions. If you have the homeowner's mortgage interest, deduct it, but you don't create homeowner mortgage interest payments in order to have a deduction, because there's no 100% tax rate. It's one of those things that, again, if you have the mortgage, great, go ahead and deduct the interest if you itemize. And again, this is separate because it's not going to be itemized. But if you have the car loan interest, great, deduct it, obviously. But don't go and borrow money and pay interest payments and pay $10,000 worth of interest payments so you don't have to pay $2,000 of income tax. Better to pay the $2,000 of income tax and save the extra $8,000 rather than it is to pay $10,000 of interest payments just to create the tax. So pay attention to that. Hopefully, for those of us who tend more towards frugality, hopefully this will goose the new car marketplace, which would be great. Goose the economy, goose the car manufacturers, and hopefully this will create lots of new 3-year-old cars for us to buy at half price. So that's for me to buy at half price anyway. You may do what you like, but hopefully this will create lots more 3-year-old cars for me to buy, and then hopefully that'll trickle on down. Because one of the great problems of the car market right now, especially since Cash for Clunkers, is that there's just not nearly as much inventory available in like the $4,000 car range that poor people really need in order to get started. And so hopefully this will trickle on down, and lots of people will go out and buy new cars and deduct their interest, and then lots of people will have 3-year-old cars and sell off their 8 and 10-year-old cars to get their 3-year-old cars, and hopefully this will all trickle on down. Time will tell. All right, next, Jeff continues. So let's break with something. Let's have a mind break with something easy. The standard deduction permanently stays roughly the same, which is about 2 times the old deduction. But there is a slight extra bump beginning this year in 2025. The new 2025 amounts for married filing jointly are $31,500, which is up from $30,000. Single is $15,750, up from $15,000, and then head of household is $23,625, up from $22,500. So this is having a high standard deduction, I think, is great for a lot of people because it eliminates all the complexities of itemizing deductions, and a significant percentage of people will be better off with a standard deduction versus itemized deduction. So always consider that also when you're doing things like home mortgage interest calculations and all of that. Just recognize you may not even be the kind of person that itemizes your deductions in the first place. So all that stuff is a moot point for you. Sticking with the deduction theme, let's talk about a brand new deduction, the deduction for seniors. Key details are as follows. Each taxpayer 65 or older gets up to an additional $6,000 deduction. The deduction phases out by 6% of MAGI, modified adjusted gross income, above $150,000 for married filing jointly and $75,000 for others. So, interesting note here. I'm not 100% sure, but the way I'm reading the text, see below to judge for yourself, the deduction for each person is phased out between $150,000 and $250,000. So $0 of a senior deduction at $250,000, regardless of whether one or both spouses are 65 plus. I'll skip that point here. This deduction is effective for this year, 2025 through 2028. This is the closest that the OBBB gets to the Trump campaign promise of no tax on Social Security. This isn't that, but to be fair with it, nearly 90% of senior Social Security will be tax-free, which is up from 2/3 currently. To the opposite, so that's great. So a new, again, taxes on Social Security, it's kind of one of those things where it's really wacky when you think about it. The money's taken from you, then through the form of a tax, then it's paid to you, and then you pay income tax on that employment tax that you already paid. It's kind of a wacky deal, but this goes a good way towards President Trump fulfilling one of the goals that he had. And hey, more tax deductions for seniors, I'm not going to be upset about it. And we see, I think, the trend. If you think about how these things are positioned, this is the general trend. We're going to provide additional tax benefits, and then they're going to be phased out as income. So if your income is $300,000, you don't get this deduction. And that's the basic trend of most modern tax planning. And as we deal with significant deficits, I think that's going to continue to be the case. To the opposite extreme, children, and more specifically, the child tax credit. Very similar to what we've had, but with the following changes. A slight bump to $2,200 per qualifying child, up from $2,000, inflation adjusted, and permanent and effective this year. Now, this makes me happy to see the child tax credit enhanced. As you know, I care a good bit about population growth. I have a dream to someday see 1 billion Americans in the world. Unfortunately, most Americans don't seem to hold my dream, so we'll see how things can happen, but we're a long way off from that. I would like to, and of course, first we got to get back to replacement rate. I'd like to see Americans at least get to the point of replacing themselves rather than being a declining nation. I don't think any nation in decline is a fun place to live. So it would be great if we could get our birth rates back up to 2 children per woman and maybe even get back up to higher than that. And wouldn't it be amazing if over the coming years and decades, we could raise our fertility rate in the United States of America up so that our population could actually grow and increase. And again, my dream would be to see us with 1 billion Americans. Would just be amazing. Unfortunately, we're a long way off from that. I'm grateful, though, that at least things are being talked about. Felt like for many, many years I was the lone voice crying in the wilderness. And today, it's nice that lots of people are paying attention to this. And one aspect of this is clearly government policy and tax policy that needs to be talked about. The child tax credit in the United States is a very important tax credit. It's very important to discuss. It's very important to use. And it actually, I think, is a very effective tax credit. Now, it'll be interesting to see what happens in years to come. But I think that the direction we're likely to go in the coming years is that we're basically going to go more and more in the direction of paying people to have children. And there are different ways of doing this. Now, I used to think that these programs were just not effective. Today, I'm not sure. I don't know if they're effective or not effective. They seem to have some impact, and everyone's arguing about the level of impact. But it seems like it's certainly going to have to be something that people do. So the American approach up till now has not been to pay people to have children, but rather to offer generous and helpful tax breaks. And I think that's good. That's a good approach. Will that change in the future? Will some of these child tax credits become refundable? Will you actually get a direct payment from the government for having children? Well, it was floated during the negotiations related to this one big beautiful bill, and as part of that conversation, the ideas were discussed, and that's the first step to getting to programs like that. I don't know that we need to. I'm just happy to see the child tax credits increased and expanded a little bit. And I would say that, of course, don't have children to create tax benefits, but these tax benefits are generous and will become increasingly generous. The only people that really matter to the future are those who are reproducing. And so government policy, in order for government to maintain its power and its authority, there needs to be people in the future to be governed. And so therefore, the government has a vested interest in incentivizing that in some way, shape, or form. Now, I did an interesting, just a personal research project a year or two ago, and I think it was a year ago. I never shared it as a podcast, but I sat down with AI and I modeled out a specific scenario for a person with children, and I compared every single country in Europe to the United States and to Canada, and I modeled the tax rates based upon having children. I did that because I was interested in the Kindergeld system in Germany. Germany has a program called Kindergeld. Kinder is child, and Geld is money, gold, Geld, same thing. So child money, child payments. And so if you are a German resident, and you have children, you will receive a direct payment from the government on a monthly basis for each of your children. And these payments can be quite substantial. So I checked across all of Europe, including the European Union, as well as the Nordic countries and Switzerland, and I modeled as best I could. I modeled the actual payments for each of those. And I also modeled it for an American. And I was thinking, you know what? I wonder if it would be if he'd be better off to, if I've got all these children, I wonder if I'd be better off to pull up stakes and go and live in Germany and collect Kindergeld as a straightforward payment or live elsewhere. I came to the conclusion after that research project that no, actually, with the total effective tax rate, I'd be better off living in the United States. That if I just was going to sit around and do nothing except not earn any money except what I had for children, of course, I'd be better off in Germany, because at least there'd be some payments. But if I was actually going to earn some money and be productive, the amount of total tax that I would pay living in the United States is so much lower than the total tax I would pay in Germany that it dramatically offset the straightforward Kindergeld payments that I would receive if I were living in Germany. So do with that what you will. It was an interesting mental game for me to go through. But at the very least, I'm happy to see these child tax credits expanded. I think that's clearly going to be the rate of the future, that we have so much money available that having a clear orientation in favor of people who have children seems like the obvious pathway that our tax code will take in the future. For now, what it means is that you can, if you have a good number of children, you can be very lightly taxed in the United States. You can earn at a very good rate, and you can be very lightly taxed in the United States. So take advantage of that if you are inclined towards having children. Continuing on with Jeff's thread, while not as readily used by taxpayers, as long as we're on the subject of children, let's talk about the adoption credit. The OBBB adds some future inflation adjustments, but the bigger news is that effective for 2025 and following, it makes up to $5,000 of the credit refundable. That's great. Anything we can do to make it affordable to adopt children, I think is a great move. Let's talk AMT. The goodish news for most preparers and taxpayers is that AMT will continue to be a non-issue for most people. That said, thanks to a somewhat odd choice in the OBBB, where we're essentially going back to the future, more taxpayers will be hit by it. What do I mean by that? Well, remember how the Tax Cut and Jobs Act dramatically increased the exemption amount and income phase-outs of that exemption? Well, for 2026 and following, the OBBB would reset the level at which phase-outs begin, back to $1 million for married filing jointly and $500,000 for single filers, what they were in 2018. So basically, you can kiss the last 8 years or so of inflation adjustments goodbye. That's not insignificant, as this year, the phase-outs for joint filers begins at $1,252,000, which means a reduction in the phase-out of $250,000 plus. All right, time for another easy one. Effective next year, the lifetime estate and gift tax exemption will be $15 million per person, indexed for inflation. A few quick notes, it's still portable, so this is effectively $30 million per couple. The jump to $15 million is just over 7% more than the current $13.99 million amount, so it's going to represent a modest increase beyond what we would have had solely due to inflation. Comment on this one. This makes me happy, just that the estate tax can be just eliminated for most people. When I got into financial planning, just a couple years before I started financial planning, I think, if my memory is correct, the estate tax was phased in at $750,000, something like that. Anyway, the point is that for a long time, it was just these super low numbers of how much you were exempted from. And then in the 2010s, it started to go up. It was $5 million, and then it increased, and now it's up to $15 million. And the estate tax is such a dumb tax, but yet, I'm not going to say that it's totally dumb, but it was just silly to get so many just ordinary people mixed up in it. And so I don't know whether it should exist or shouldn't exist. I don't think I've ever voted or I've ever kind of wished for any taxes, while of course acknowledging that some taxes need to be put in place. And I've had my various libertarian fantasies about what would be the ideal tax structure, but I don't spend much time thinking about that anymore. The point is that having it at $15 million per person, $30 million per couple is good. Get rid of it for just normal people. Keep it for rich people that have the time and the inclination to do the planning for it, and then let that be something that gets considered separately. It always needs to be there in the back of your head, but the idea of having somebody with $1 million home or $1 million net worth being wrapped up in the estate tax to me is unreasonable. Number 52, on to some big breaks for business owners. Let's start with a massive expansion to Section 179. Two huge changes here effective this year. Number one, the maximum amount eligible is $2.5 million, up from $1 million. And the phase-out begins at $4 million a property, up from $2.5 million. Oh, and it's permanent. So get to that 179 spending this year. Let the government underwrite your expansion and goose the economy. And then there's special depreciation, also known as bonus depreciation. 100% bonus depreciation was introduced by the Tax Cut and Jobs Act, but has been phasing out in recent years. The OBBB permanently reinstates 100% bonus depreciation for qualified assets placed in service January 2025 or later. All right, and what will be our final topic for this evening? Let's talk about OBBB's creation of a new tax favorite account, the Trump account. Note that these were called MAGA accounts in earlier drafts. Here's what you should know about these accounts. The first contributions to be allowed 1 year after enactment of law. Contributions only allowed before the account beneficiary turns 18. $5,000 annual contribution limit, and distributions are generally prohibited prior to age 18. The tax treatment will generally mirror that of an IRA. Note, this is a big difference, a downside, from the capital gains treatment that was part of some draft legislation. In general, the account must be invested in a U.S. mutual fund or ETF that meets the rules highlighted below. Let me read the rules to you. That it tracks the returns of a qualified index, that it does not use leverage, and it does not have annual fees and expenses of more than 0.1% of the balance of the investment in the fund, and 4, meets such other criteria as the Secretary determines appropriate for purposes of this section. By the way, can we just all stop and thank St. Jack Bogle, for creating a situation where 40 years later we can have federal law that limits expenses as no more than 0.1% of the balance of the investment in the fund for a government account. Thank you, St. Jack. No deduction allowed for contributions to the account. The IRA pro rata rule will apply to Trump accounts, but separately from the regular traditional IRAs, and employers will be able to contribute up to $2,500 to the Trump account of employees' dependents and exclude from income. So these Trump accounts, I think, are interesting. The basic early discussion is, okay, these are fine. So as I understand it, which again, subject to all kinds of new research and things that needs to happen. But as I understand it, the government will put $1,000 into the account when you open it. So obviously that should be open. Take your free $1,000 to get seated and then wait and see what happens. By the way, wouldn't it be fun to just have somebody, everyone should have this account, have it open. It gets seeded with $1,000. It just gets invested in an index fund. Let this account sit there for 100 years, and we'll have our true example of what does the U.S. stock market do over the next 100 years. This is going to create some fun data for us to analyze in the long run. So take the $1,000 for free. Absolutely. Now, as I understand it, once the government seeds the account, then of course the parents can contribute up to $5,000 per year post-tax to the portfolio that's invested in the index fund. Employers can contribute to employees' children's accounts as well, up to $2,500 a year, and an amount that won't count as income to the worker. So that'll be a nice tax-free benefit. I think you'll see these more used. Sign it up. Here's an extra $2,500. The company deducts it as a payment to its employees. The child receives it, and the parent is not taxed on that. It'll be fun to see how this plays out with, again, family businesses, close-held businesses. This may be another fun thing that we can set up. So we'll see. Account holders can't touch the money until they turn 18, after which the accounts are treated much like a traditional IRA. So let's just do some math and try to figure out what's the potential size of these accounts. Well, if we just start with $1,000, if we invest $1,000 one time and then leave it alone, and let's say it grows at 10% in an index fund, then that would be about $5,500 for the 18-year-old, which is pretty cool. What if we max this sucker out, right? Government puts in $1,000, you put in $5,000 yourself, and then you put $5,000 in every year for until age 18. Well, 10%, you're looking at about $236,000 in the account. So that's pretty cool. If it turns out that way, that would be a pretty cool way to grow some money. Now, is this, the best type of account? Well, I think the argument that a lot of people would make would be, no, it's not. It's not the best. It's not superior to a 529 account. It's not superior to, say, matching your children's contributions to a Roth IRA. And I think it has to do primarily with how you can make the withdrawals. So account holders on these accounts, as I understand it, can make partial withdrawals when they turn 18, and then they can access the full amount at age 25, but only for qualified purposes, which includes paying for college, starting a business, or buying a first home. And then they get full access to the funds at age 30 to use for any purpose. But once the accounts are cashed out, then the distributions will be taxed as long-term capital gains if they're used for a qualifying purpose, and anything else will be treated as ordinary income. So that's not quite as good as putting the money into a 529 account, where you then take it out for education tax-free, or a Roth IRA where you take it out tax-free for retirement. So it's going to have its place. I like these types of things as goal-setting mechanisms for people to make for their children. So I think one of the powerful things, and I did not emphasize this earlier in my career, but I now see the value in a way that I didn't before. One of the powerful things about having accounts like these is that many people will then have an incentive to fill the thing up. And so if you know, hey, here's an account that I could put $5,000 in, then that becomes the goal. Every year I want to put $5,000 into that account. And you get more and more money saved towards it. And I think that accounts like this that make it easy for parents to transfer money to children and and so that the child controls it, that are sheltered from taxes, are really helpful. And I think it's also really helpful to look at this from an asset protection standpoint. So that's what I'm always clued into. I don't know the rules yet. I will wait for kind of the IRS to write up the more user-friendly versions of this and see what it looks like. But it'll be one of those things. Fill up these accounts? Sure, go for it. Why not? And so one thing that makes me happy is we've got so many great accounts that we can use for children now that for parents with the money to put into them, I think there's lots of options. You don't need to necessarily get into writing your own custom trusts and dealing with trust taxation. With a combination of Roth IRAs and 529s and now these new Trump accounts, which I guess is what we're going to be calling them. I don't know what they're going to be calling them other than Trump accounts, but it's good to have these options and, fill them up, transfer the money to your kids and teach your children how to use them. All right, let's round out the tweet thread here. Finally, the OBBB calls for a pilot program in which the IRS will fund the Trump account of a child born between 2025 and 2028 with a $1,000 contribution. If the beneficiary dies before 18, the money is taxable right away to the account beneficiary or on the child's last return if their estate is the beneficiary. And that is it. So that's the extent of Jeff Levine's tweet thread with some of the interesting and tantalizing aspects of the new One Big Beautiful Bill. By the way, I've decided that basically one of the secrets to becoming rich and successful is to lose any sense of personal shame. The idea of me calling, imagine I'm a legislator. I'm just like, I've got the one big beautiful bill. It's just like, makes my skin crawl, the idea of doing that. And yet I have to concede that it is a superior model. Sometimes I look at Suzuki has their XL7. I guess I'm just compare that to the Volkswagen Jetta. All right, you got to have names that are memorable for stuff. And so I guess people who are politically savvy have clued into that and say, I'm going to name my stuff myself. Obama should have just named his bill Obamacare. Now we're going to have the Trump accounts. I guess politics is marketing now. Overall, I don't know. Those are the things that you need to know about financial planning. It relates to the new One Big Beautiful Bill. I don't, we'll see. There'll be some clarity that comes out from the IRS. We'll get some documents in the coming weeks and months, and that will be helpful. And your accountant will see what applies to you. All the tax books will be updated, but that's the hot off the presses information. I don't have any political commentary to add to it. I think it's sad that we can't make more progress with cutting expenses. But that's probably the price you pay for political success. It seems like cutting the bills isn't something that really anybody wants. And since we don't have to, well, why bother? And so let me refrain. I don't have any more political commentary to make. I've pretty much walked away from political commentary. I hope that it works out well. I hope that the American people are benefited by the work of our leaders, and I hope that our leaders are making good decisions. It's just amazing the size of government that we have built, the size of the state. We're going through a period where we're reinventing government, we're reinventing the political system, and that's not going to come without its growing pains. So I just hope that we can make progress and pray for your political leaders that God give them wisdom and that they be responsible with the authority and the power that with which they have been endued. That's it for today. Thank you for listening. I'll be back with you soon.